If you were starting to invest right now in May 2026 and you wanted the smartest, simplest way to build long-term wealth, what ETFs would you actually buy? And quickly, if you're new, an ETF or exchange-traded fund is basically a bundle of stocks you can buy in one trade. Instead of trying to pick individual winners, you're buying a whole group of companies at once, which gives you instant diversification and reduces risk. So let's go through the best ETFs to look at right now and how you'd actually use them. First up, and this is the foundation of almost every portfolio, is the S&P 500 ETF. Think VOO. This tracks the 500 biggest companies in the US like Apple, Microsoft, Nvidia, Amazon, all in one. Historically, the S&P 500 has returned around 10% per year on average, and the fees are incredibly low. This is what most long-term investors build around. If you're only buying one ETF, this is probably it. Next, if you want even more diversification, you've got VTI, the total US market ETF. Instead of just the top 500 companies, this includes basically the entire US stock market, thousands of companies, so you're getting exposure to small caps, mid caps, and large caps all in one. A lot of people call this a set and forget ETF because you can literally just keep buying it over time and let it compound. Now let's talk growth, because this is where things get more interesting. QQQ, the Nasdaq 100 ETF, is heavily focused on tech and innovation. We're talking AI, semiconductors, software, basically the companies driving the future. This ETF has historically outperformed the broader market during strong periods because tech leads growth. But it is more volatile, so you need to be comfortable with bigger swings. Higher risk, but also higher upside. If you want to go even more focused into tech, there's XLK. This is a pure tech sector ETF, so it cuts out a lot of the non-tech companies you'd find in something like QQQ. This means you're making a stronger bet on tech continuing to dominate. With AI driving earnings right now, this is one of the highest conviction areas in the market. But again, it comes with more risk. Now let's balance things out a bit. If you don't just want growth and you actually want income, look at SCHD, the Schwab US Dividend ETF. This focuses on high-quality companies that consistently pay dividends. These are usually more stable, more mature businesses, and they can give you cash flow while you hold them. It's not as flashy as tech, but it's solid, especially in uncertain markets. Another really interesting ETF that's getting more attention is COWZ, the Cash Cows ETF. This one focuses on companies that generate high free cash flow. In simple terms, these are businesses that are actually making real money, not just growing on hype. It's a bit more of an under-the-radar pick, but it's performed really well across different market conditions. Now here's something most beginners get wrong. They only invest in the US. But adding international exposure can actually reduce your risk and sometimes improve returns. That's where something like VT comes in. This ETF gives you exposure to thousands of companies across the entire world. US, Europe, Asia, emerging markets, all in one. It's one of the simplest ways to go truly global. And finally, if you're worried about volatility or market crashes, there's USMV, a minimum volatility ETF. This focuses on stocks that don't swing as much as the broader market. It won't explode during bull runs, but it can protect you during downturns. Think of it as a stabilizer for your portfolio. So how would you actually put all of this together? A simple, strong portfolio could look like this. Around 50% in VOO as your core, 20% in VTI for extra diversification, 15% in QQQ for growth, 10% in something like VT for global exposure, and then 5% in either S, CHD or USMV depending on whether you want income or stability. That gives you a mix of growth, diversification and risk management without overcomplicating things. And here's the bigger picture. ETFs are exploding right now. More and more investors are moving away from picking individual stocks and into ETFs because they're low cost, diversified, and over time they outperform most people trying to beat the market. The truth is, you don't need to be a genius investor to build wealth. You don't need to predict the next big stock. You just need a few solid ETFs and consistency over time. If you're in your 20s or just getting started, this is one of the simplest and most effective ways to do it.